David, welcome to you. Where would you say you most differ with the market or with consensus as you currently see it?
I think that we think the broader market is going to do better, that we think technology will be fine, but we think that the spread in terms of other areas like value and dividends and small cap doing better, we think that's going to take and continue for the next 12 to 18 months. We think that's where the biggest opportunities are, and we think that a lot of the market is still chasing the Magnificent Seven as those are the hottest and most popular stocks.
So I don't know if you'd be buying the Russell 2000 per se. I know you're more of a stock picker, but what do you make of its underperformance since the rate cut last week?
Well, it did run up a lot a few weeks before that in anticipation. We think if you have a 12-month time horizon that the Russell, the S&P small cap is going to be a good place to be. Not that it's going to shoot the lights out, but it has underperformed for the last 18 months. We think it's going to play some catch up. And we think a lot of areas of the market are going to continue to do that. Very interestingly, if you look at the sectors in the market over the last 6 months, a lot of sectors that did poorly last year have started to really perk up in a very meaningful way. Financials, utilities, healthcare has even picked up. And interestingly, under the radar, or in fact, probably people are aware of it, technology has been one of the weakest performing sectors this quarter. We think you're going to have lots of rotations, and the things that have been hottest are going to cool down.
Which names in finance, in healthcare, would you be chasing?
Well, Becton Dickinson is a very good business. They've actually had a pretty good quarter and outlook this year, but the stock has done very poorly. We think that's a great opportunity. It's at about 17 times earnings. U.S. Bancorp on the financial side has been one of our lagging banks, even though the business is pretty good. They had an investor day a week ago. We think it was pretty upbeat. Their balance sheet's in a lot better shape. Their capital ratios are good, yet the stock has really done very little relative to the group. So that's an opportunity on that side.
I also thought it was interesting you like Nestle. We've talked to Chris Grisanti about Hershey quite a lot. I don't know why these chocolate, Nestle a little bit less so. They do still do the chocolate business, do they not?
They do still do the chocolate business. It's one of the world's biggest food companies. The stock has done pretty poorly. It's down about 15 to 20% in the last year. As a result of it being down, it's now at a pretty attractive valuation, about 17.5 times earnings, pays north of a 3% dividend yield. We think ultimately it will be a good business, should sell at a higher valuation. It's off on some fears about the weight loss drugs. We think that that's really not going to have a huge, meaningful impact on their business on a long-term basis. So basically a very good company at an attractive price. Also, the market's been pretty volatile. We think that volatility is going to pick up. And after a great run, we think having some consumer staple protection is a good place to be.
You mentioned U.S. Bank, and investors have been struggling to find kind of a good story to tell about the banks more broadly, whether it's the regionals or the big banks. Do you like the financials broadly here? And look at the investment banks, which have been one of the best areas to be invested in the last couple of weeks. The rate cut is accelerating that. Or do you just like stock-specific stories like U.S. Bank?
We like stock-specific stories, but we do think financials, which have had a great run over the last 15 months, are going to continue to be a very good place to be. A slowly declining interest rate environment from the Fed is good for the banks. The valuations are very attractive. The commercial real estate, which has been a concern, the problems with that are going to be a little bit less with lower interest rates. There's going to be a pickup in lending. So a lot of things are going to play toward banks. Quietly, they've been a great group. We think that continues.
That's a pretty good story to spin if people are looking for one. All right. Let me end with FedEx then, which has been under such pressure. And, you know, I guess once people stop needing this urgent shipping need on their air freight, they're moving back to the lower margin business. It's got a lot of headwinds. Why do you think that's a high quality stock people should pick up here?
Well, they're getting hurt because of the slower economy. And you're right, people trading down and lower cost shipping. It has a new management team. We think they're doing a terrific job streamlining the business, cost cutting, and the economy and the global economy is going to start to pick up with lower interest rates from both the Fed and from Europe. And as that happens, we think you're going to see upside earnings surprises. In the last quarter, they had a pretty significant downside surprise. We think the negatives have been factored into the stock. It's off about 11% in the last week or two. At this point, you're buying it at 13.5 times earnings. They are one of a few players in their business, and they also are considering spinning off a business or monetizing the trucking business. So lots of moving parts, and we think most of those moving parts are going to be to your benefit. It's a great entry point.
And I'd be remiss not to mention Apple is one of the tech names you like as well. That's been a battleground lately. David, thanks for joining us. We'll check back in soon.